Okay, welcome to the Order Flows Delta Scalper. How Delta can help you determine shifts in supply and demand. My name is Michael Valtos. I'm the founder of orderflows.com. First, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. So, what is Delta Scalper? It's a tool I developed. It's an orderflows.com tool designed to pick up potential shifts in supply and demand, which are caused by big orders getting filled in the market that otherwise may go unnoticed. One of the questions that I get asked quite a bit is, is there a way to use order flow analysis without having to look at a footprint chart? So, I've tried to come up with, probably, my best way, which is this way, the Delta Scalper. For those that want to use order flow analysis without having to use a volume footprint chart. I don't necessarily recommend that because I feel that the trading with a volume footprint chart, you're analyzing the market on what's happening in the market. If you're just looking at a normal bar chart, you're not necessarily understanding what's actually going on. The buying and the selling that's happening inside the bar. You don't know which side is being aggressive, and if the bar is moving on decent volume. So, I always wanted a way, and I sort of came up with it with this Delta Scalper, a way for, traders to sort of jump past trading within a volume footprint chart. I do think volume footprint chart will help any trader, whether they're a new trader or, someone that's been trading for 10 years. I think, the information that you get from a footprint chart is puts you head and shoulders above the rest of the traders out there. So the agenda for this presentation, just real quick. Who am I? How do I know what I'm talking about? Why you should listen to me? I could just be some do you want to listen to some college dropout tell you how to trade, or you want to listen to somebody that's got legitimate experience? It's up to you. So what I'll do in this presentation, I'll take a look at the institutional side of trading. What is order flow in Delta? Why Delta matters? I'll explain the reasoning behind Delta Scalper. You'll see the Delta Scalper in action with examples and explanation. The best types of charts to use, and at the end, I'll have a special offer for you guys. So just to start out, okay, who am I? Okay, my name is Michael Valtos. I've been in the futures industry for almost 20 years. On the corporate side, I was with J.P. Morgan for 8 years, Cargill for 4 years, Commerce Bank for 3 years, Mann for 2 years. I started with Dean Witter on the CME floor, and I was with them for 3 years. I was on the CME floor, just as Globex was taking hold, and I left after about 1.5 years on the floor. I went upstairs to their global macro desk, and really my life changed. The industry changed. That was the big shift in going electronic. But once I went up to that desk, once I left the floor was a great experience. But once I leaving the floor, I was really exposed to some brilliant traders and and markets around the world. When you work on the floor, there's no floor anymore. So, but in the past, when you work on the floor, you become a specialist in one market. But when you leave the floor and you're working on a trading desk, you're really got to be an expert in all the markets. Well, you don't need to be an expert, but got to understand all the other markets rather than just one market. It was interesting when I was at Commerce Bank. I hired a guy, and he was from the bond floor. And it's funny because when he told me about 6 months into it, he says, what you guys do on these trading desks are amazing, because when I was on the bond floor, he ran the bond desk for Aubrey Lanston, and so he followed bonds, 10s and 5s, and he used to say, people will come to him and say, wow, you're the man because you cover these bonds, 10s and 5s. He goes, but I had no idea what's covered off, what you guys got to cover off the floor. You got to cover, bonds, 10s and 5s. You got to cover euro dollars. You got to cover the currencies. You got to cover the stock indexes. And those are just the contracts in the U.S. Then you got to cover all the foreign interest rates, all the foreign stock indices, and everything else. So so follow me as I take a serious, step-by-step hard look at order flows, delta, that produce excellent trading opportunities, and then see how you too can find profitable trades from the untold, little-known, often overlooked secret of order flows delta. Okay, I'll say it's unique to order flows. It is available on other footprint packages. I mean, Market Delta has it, Noft has it. I believe Indicator Model, their footprint chart has it. A lot of other software has it. But that's just even the Gomi ladder, which you can get for free from Big Mike's. I think it's futures.io now. But you can get the delta. But you're looking at delta, and if you don't know, it's just a number. If you don't understand it, then what's the point of it? It's like having a fancy car, but if you're a lousy driver, it's kind of pointless. But before I get started, I want to explain I'm a trader, right? I came from the institutional side of the market, so many of the concepts that you're going to hear me explain are based on my own experience, trading large orders. I've tried to have these concepts programmed into easy to use indicators. I hate to admit it, but I've sort of had to become an indicator guy, in the sense that my concepts are being programmed into indicators for traders to use in their trading. And I hate to say, oh, you buy when there's an up arrow or sell when there's a down arrow, but people ask me to teach them how to trade, and I do. I got no problem with that. But I know that they struggle. I said, I've been, looking at the markets, for 20 odd years, and I know what I'm looking at, and I want to make it easier for people that are still learning. I'll say struggling, but have issues in trying to wrap their head around some of these concepts. So that's why I'm having these concepts programmed. So imagine for a moment the possibility of determining the direction of a price movement before it happens without relying on analysis of price. You probably think I'm crazy. Now, everybody is very price-centric. Indicators are price-centric. They're based on price. They mathematical computations of price. Everything is based on price, and price is not the end-all, be-all. And not all prices are the same. I've gone into it in other presentations about just trading based off of prices. Now, delta deals with things beyond price. Okay, so it's not an indicator that's based strictly on price. Everything, the whole slew of indicators out there, for the most part, even the vanilla indicators that you're seeing on NinjaTrader are based on price analysis. Delta is not. So, before I jump into understanding Delta and the Delta Scalper, I think I need to explain the problems an institutional trader faces in the market these days. I listen to a lot of these other, these webinars that are, presented by NinjaTrader for, other software, and, they would have you think that, oh, these institutions out there, they're trying to squeeze the small guy, they're trying to pick him off. Really, they're not. I mean, it's easy to say, oh, this fund that came in, was waiting for, the retail, sucking in the retail traders, and then we'll go and slap them. It's, more often than not, institutional traders have big orders, and they're going to move them when they can. They don't care that, they're not trying to lie in wait for, some, a bunch of small traders to come in with some small, 2 lots, 3 lots, and then just, sort of pick them off. That they're not. And I think that, what happens is you get 1 or 2 people saying that, then everyone else starts saying it and taking it as gospel. It's really not. A perfect example is, if, someone's got, 3,500 5-year notes that they want to get done, and they see they can get it done without moving the market very much, they're going to do it. Whether there's, whether it's at a high, if they got to buy it, and they're going to get the position on, they're going to do it if the liquidity is there. What they're really looking for is the areas with liquidity, and they're going to act. So a lot of people don't realize there's been an arms race going on at banks, hedge funds, and to a smaller extent prop trading firms in terms of algorithmic trading in respect to order execution to minimize market impact of large orders. If after the crisis in 2008, everything in banks was basically frozen, in the sense that new hires, expenditures, that was all frozen. The one department that basically had not carte blanche, but had a big budget still was the algorithmic trading teams. Not trading teams, rather the development teams. I was even surprised that when I learned how big J.P. Morgan's was. I didn't think it was that big. Honestly, maybe I'm an idiot, but I thought it was just maybe a handful of people cranking these things out. In Singapore they had it was on another floor, and they had literally, it looked like over 100 people working on it. I'd see them at the Christmas party. Someone would introduce me. Oh, hey, this is so and so. He's working on the futures algorithmic stuff. I had no idea that we had these guys there. I'd have maybe about 2 or 3 people that I would talk to on a regular basis, but behind them there was a whole floor of staff working on these things. So, imagine you're an institutional trader, okay, and you have 5,000 lots of E-minis to buy. What are you going to do? You got to decide. Do you just bully through the market, or do you try to finesse the order to get a better average price? Now, I have explained before, to people that, for large orders, basically what, the institutional traders do, they're concerned with their average price. So if, say the market is 2021 bid at 2021 and a quarter, and there's, say 300 on the bid, 500 on the offer, at a half there's, 600, at 3/4 there's, 1,200, at 2022 even there's, 1,500. If this person, if the guys can see, hey, I could buy most of my order up to 2022 and only move it, a point, he knows that his average price is going to be somewhere around, 21.65, for most of the position. He'll do it because, he's not really impacting the market that much. Rather than sit there and try and finesse it, lift buy 100, see how it takes it. You can do that too. That's what algos do nowadays, for execution algos. They try to finesse the order. So, institutional traders live in a different world than prop traders. Both traders want to maximize their trade alpha, but the institutional trader is looking for ways to increase execution alpha. There's a cost to executing a large order, whether you want to admit it or not. If you're a large hedge fund, and I said, these large hedge funds have positions that are massive. They could be, 120,000 bunds. It could be 70,000 mini S&Ps. Now, when you're a small trader, you think, wow, I had a slippage of a tick, on my 10-year trade. Okay, so a tick is what, $15, right? This trades in half ticks, and but imagine you're a hedge fund and you get a slippage of 2 ticks, but it's on 20,000 lots. That's a massive amount of money. It's 2 ticks, and 10 years is 31 and a quarter on 10,000 lots. That's $300,000 right there in slippage. So if there was a way that they can save on the execution, even if it's just by a half a tick, then they're going to want to do it. That's what execution alpha is. So institutional traders use execution algos to slice and dice their orders so as to minimize and reduce their market impact. Banks and hedge funds are spending tens of millions of dollars to minimize execution costs or slippage and to improve their execution alpha. They've got I remember one day I came in to work at Cargill, and then I saw stacks like this outside by the elevator. They're still in crates, but they're all servers that the company had just bought. I don't know if they were used. This was in 2002 or 2003, if they were going to be used for that. But these companies, these banks, they're spending tons and tons of money on algorithmic trading, because that's how they're going to separate themselves between the other banks. You say, a hedge fund has, their choice of which prime broker they want to use, Goldman Sachs, JP Morgan, Credit Suisse. And, oftentimes it comes down to which bank could offer the best, execution services oftentimes. When it's a big hedge fund, with billions of dollars under management, any improvement in alpha is going to affect their bottom line. So, they're going to want to do it. So, what are some of the common problems for institutional traders? Knowing when to do nothing and leave well alone, when to be aggressive, when to be passive. The end goal is a better average trade price for the trade. So, if, in the old days, right, an institution would just call down to the floor, and, the guy, their broker would work the order. The guy in the pit, some of the big companies would have their own guys in the pit executing it, and or have the broker that they trust. They give them discretion not to move the market, sort of feed it in. Now everything's electronic, and these execution algos have replaced the floor broker, the pit broker. So a good institution algos will understand the market. It's not like equity algos. It's sort of a different piece, because in futures you got so many different markets, and they're not all the same. Different liquidity at times a day, things like that. So good execution algo will again increase your give you better returns, better fills. Okay, so institutional traders are all about making money, and obviously once they start to make money, they want to make more. So order management algorithms give these guys more opportunity to manage their orders to increase execution alpha. It gives the traders, the traders at the hedge funds, or at the banks, it gives them, if they know that they have a good execution algo, they don't have to worry about the execution part. Okay, they know that order's not going to get butchered in the market. They could concentrate more on the trading aspect. It's like these hedge fund guys. I everyone talks about, making tons of money. And, so any way they can, I said, increase their alpha, they're happy. So, what Delta Scalper does is highlight the areas where an institutional trader may be trading a big position. When a big order that will impact the market is being executed, that may not easily be picked up, if you're just looking at a DOM or time and sales or any other type of chart. If you're just looking at a bar chart, you're not going to notice the volume numbers. You're not going to notice, who's being aggressive, who's being, if it's passive or anything like that. You're not going to get that on a normal chart. On a DOM, you might be able to pick it up, but it's something you got to be staring at, and you have to have experience in looking at a DOM, I think, to pick it up. Time and sales, forget about it. It just scrolls on so fast. You're seeing all these numbers going on. You might as well just be looking at, raindrops falling down on your window on a rainy day. But I'll get into a bit more on how it's, on some of these institutional, on some of these algos, to sort of explain, why, how these things work, and so you can understand, what you're looking at sometimes. I mean, it's not like you're looking at you see volume on a footprint chart of 2900 and you think, oh, someone just bought it up. It doesn't always work that way. It could be fed in, there's, I'll talk in brief about some of these execution algos in, a little bit later on. So, let's just jump right in with, talking about order flow and delta and everything. So it's often been said that volume precedes price. Why do traders say that? Because it takes volume to move price. Okay, the market's not going to move unless someone's trading it. Right. So when the market is trading, 1950 bid offered at 1951, it'll take volume on, buying volume to move the market past 1951, and conversely, there would need to be selling volume to push the market down below 1950. If I said, the market's offered at 51, if you're going to trade 52, first someone's got to buy the 51s and then buy the 52s. If we're going to go down, trade 1949, 1948, someone's got to sell the 50s, sell the 49s, to get down to 48. So who can move the market with volume? And when I say move the market, I say, with conviction. I mean, anybody can move the market with, at any given time, sometimes with, smaller volume. But I mean, the real moves, the real moves that which the real moves that you want to pick up on. So, it's real money. What's real money? Real money is, sovereign wealth funds, things like that. Large hedge funds, commodity trading houses, and, institutional bank traders. So when these traders are active, they try to hide the volume of their orders, but what they can't hide is what they actually trade in the market. So, they, like I said, going back to the execution algos, there's all these different ways out there that they can hide their order, hide their intent on what they're trying to do. But once they trade it, it's there for everyone to see. So, unless you have unless you know what you're looking for and have a way to pick up on it, then you're not necessarily going to know it, because good execution algo will hide it, will minimize market impact. So when you look at a chart and you see price traded, you begin to form an opinion of the market. But when you see the volume that was traded, you see the conviction of the market. What that means is, when you see, price is going to trade back and forth. So there's always going to be, a bid and an offer trading generally. But when you see, volume really start to pick up, you sort of see the conviction of the market. Can be, I want to say in general, because, sometimes it could just be, a few small but large, I want to say small, it could be a handful of large traders coming in and moving the market. But what if you can break down the traded volume and determine what percentage of the volume was traders buying the offer against traders selling into the bid? You can. That's what Delta is. So, Delta has been around for, maybe 10 years or maybe a little bit longer. I mean, really, I really think the first company that, really brought it to the forefront is Market Delta. Market Delta is is very good charting software. If you want a good volume footprint. I mean, it's not to say mine isn't good, but it's it's been there for 10 years. It's tested, and it runs on CQG data. My order flow software runs on NinjaTrader, so there's a difference there. So okay, real quick, if you're unfamiliar with order flows delta, let me explain it a little bit again. So you see here, right? You see the bid, the offer, and here's the size: 1955, 1956. So it's going to trade at 55. It's going to trade at 56, and you get numbers. You're going to get what's traded at 1955. You're going to see the volume. What's traded at 1956, you'll see the volume. So delta is calculated by taking the volume traded on the offer side minus the volume traded on the bid side. If delta is positive, there are more aggressive buyers. So if you have a positive delta number, it means there's more buyers, more aggressive buying going on. People who are actively buying the offer price. If delta is negative, there are more aggressive sellers, traders who are selling into the bid, selling it at the bid price. So what delta does, delta will measure the strength of the market's auction process. So if you have a strong delta number, a big delta, they'll say, a big positive delta number, real quick, let's look at a chart here. So, you see here, this is crude oil, okay? This is a crude oil chart, a 10 range chart, and you're seeing, this green line is the high. It's an indicator you could get on NinjaTrader for free. It's current open day high low. I like to see where the highs and lows are. And you come up into the high and your delta, right, which is 141. So, it's what's traded on the offer side, less what's traded on the bid side. So you add up all these numbers here, this column, you add up all these numbers, this column, and you divide, you subtract it rather. And your net was a positive 141. So there was, slightly more buying on the offer than selling into the bid. That's why you have a positive delta of 141. Now this next bar, you have a negative delta of 612. So again, if you add up all the volume on the bid side, add up all the volume on the offer side, subtract them, you'll see that there was minus 612 traded on, net, minus 612 traded on the bid side. When you get this number minus this number, you get minus 612. So for every trade to occur in the market, there has to be a buyer and a seller. At every traded price, there will be a buyer and a seller. When the price moves higher, people often say there are more buyers than sellers. That's impossible. For a trade to happen, a buyer has to buy from a seller, or a seller has to sell to a buyer. Price moves higher when buyers become aggressive and think the current price is cheap. Price moves lower because sellers are aggressive and sell their inventory to subsequent lower prices to get it off their hands, get it off their books. So, people always say, oh, why is the market going up? Well, there's more buyers than sellers. No, there's not. There's more aggressive buyers than sellers. It's a one-to-one transaction. Someone's buying it from one person, one seller. It's not like they're buying it. What they're doing is, maybe there's not enough on the offer that they're buying it to move the price up, but it's because these guys are being aggressive. These buyers are aggressive. That's what's moving the price. So when prices start to move, the reason it moves is because of a series of aggressive buying or selling, which shows up in the delta of the bar. So do you have to know the reason why prices move? No, you don't. I mean, it's, people like to analyze, try to analyze the news and everything, but, the retail trader does not have access to the latest news or is not privy to real money accounts shifting their allocation or hedge fund blowing up and need to liquidate their position. Honestly, for a retail trader, most of the time, they're reacting to what's happening in the market. They're not the reason what's happening in the market. So, and by the time you know the reason why price is moving, it's already too late. It's already filtered into the market, filtered its way through the market. So, what you need to know is how to determine when there is above average buying or selling. in the market. And like I said earlier, it's going to show up in the delta of the bar. So think about it for a minute. Would you rather buy something now for $25 when you know you can sell it for $30? Or do the opposite? You know, you want to sell something now at 30, knowing you could buy it back later at 25. That's what trading is all about. You know, people like to create all sorts of fancy indicators to see, you know, see the simple things. You know, it's basically, you know, there's basically, you know, I think 4 combinations: is buy low, sell high, buy high, sell higher, you know, sell high, buy low, and sell low, buy lower. You know, you're not trying to reinvent the wheel or anything like that. I mean, it's just basic economics. You know, you want to make a profit on something, either, you know, and there's 2 ways to do it: you buy low, sell high, buy high, sell lower. Now, let's talk about delta a bit here. So the most important component of delta, I think, is the volume. Now, remember, delta is the difference in volume between the amount that was traded on the bid versus what was traded on the offer. Majority of the time, the delta will be average, which indicates the market is doing what it's supposed to do. Now, when I say average, it'll be, you know, just a normal number, not something, you know, not a big number, like, you know, say for example, you know, go back here. Okay, so say for example, you know, you see 600. Now that's a big number. You know, 500 is also big. You know, numbers, you know, 141, 174, 164 are kind of average. You know, something like -9 is very small. There's not much difference. You know, you're talking a difference of 1 trade when you have a delta of -9, actually. So, you know, when I see it, you know, as kind of small, like, you know, close to 0, you know, say, you know, -50 or less, I mean, depending on the market. You know, this is crude oil. You know, if I saw a delta of 50, -50 in the E-mini S&Ps, I know that's a difference of 1 trade sometimes, and it could easily, you know, I'll just treat it as kind of a neutral number. But, you know, what you should know for your markets, what's considered a big delta. Obviously, you know, on a 10-range crude, 600 is big, 500 is big, 747 is big. You know, 164 is kind of average, 174 is kind of average, 141 is kind of average, 339, yeah, it's a little bigger than average, but it's not you know, not big. You know, what the market does, you know, the purpose of the market is to facilitate trade back and forth. You know, so you're going to get numbers that in general are going to be average, you know, because that's what the market is supposed to do. It's supposed to facilitate trade evenly. You know, but what's going to happen is when you get in these aggressive buyers or sellers showing up, you know, and, you know, you're seeing the delta expand. Like, you know, it jumped to -612 here. You see even in here, you're seeing selling imbalances. So you're seeing, you know, aggressive selling going on in there. So, you know, delta, you know, must be understood in context of the market. When delta is expanding positively or negatively, a trader must watch its strength to fully comprehend the shift in supply and demand. So again, you know, it's something that you must, you know, you must understand the, I'll say you should understand, you know, the market that you're trading and what's a good number, you know, what's a big, you know, what's considered a big number, what's considered an average number, you know, when you're trading with delta. Again, it's important to note delta does not take into account price. You know, just real quick, going back here. Yeah, it's just, again, it's just the difference of what traded on the bid side versus what traded on the offer. It's not what's traded on the bid side at, say, you know, 39.66, you know, or you know, 39.67. It's in this bar, what's traded on the bid side minus what's traded on the offer side. And, you know, generally speaking, if the market's going down, it should have a negative delta. If the market's going up, it should have a positive delta. But that's not always the case. You're going to get times where, you know, things change. You know, the bar can change. You know, it could be, you know, early, like this bar early, as the market was, you know, making new highs, the delta was positive. It sold off late in the bar, and, you know, the delta was, you know, got closer to 0. Closer to a negative number. You know, at one point it was positive 550. I could see that in the max delta. So I know that early in the bar it was quite strong. but later in the bar, the selling came in. So it's not uncommon to see sometimes, a down candlestick, a red candlestick with, a positive delta, or, a green candlestick with a negative delta. I mean, it it happens. Sometimes it's a function of the bar just didn't have enough volume, or, time ran out or something, depending on what sort of chart you're looking at. So by now you should understand what delta is, but you're probably wondering why it's important. Okay, so think back to the big institutional trader, the trader who has a big position on that they have to get out of quick, or position they want to put on before the market starts to move. So, they'll try their best to hide their order size. They want to hide their trade intentions to the market. When, a big trader has a lot to move, they don't want to broadcast it to everybody, because, they knew, if they start broadcasting it out to people, then, everyone's going to jump in front of you. You see it oftentimes, you see a lot of it when you see these dome traders putting out videos. They say, oh, hey, the market, someone joined the bid for, 500 lots, so you should buy the offer. Because that's, that the intention is the trader showing their hand, the big trader is showing their hand to the market when that happens, and as a result, they're often going to get a slightly, a worse fill that way. But, the one thing, again, I said, they want to hide their trade intention to the market, so they're going to use execution algos to hide what they're doing. So, the thing that they can hide is the volume that prints as soon as the trade is done. That information is public knowledge as soon as it happens. So once it trades, whether it trades 1 lot or trades 500, it prints in the volume. It's there for everybody to see and analyze and make their trading decision. I'm not someone that trades off a dome anymore. I want to see a trader's conviction, not necessarily their intention. I want to see the actual trades that are done, rather than, orders that are being layered in, pulled out, spoofed, whatever. They say spoofing is not allowed, but it sure seems to me that it's going on still. So for me, I think the real value of of technology is analyzing trades that already happened, rather than trying to read into somebody's mind. So every trade that's executed has an impact on the market. It's especially true in the futures market, where there's no concept of trading in the dark. Equity markets, you have all these dark pools and all that stuff. So, I'm not an equity trader, so I'm not going to get into it. But, in futures, it's a centralized, it's one exchange. The data is it's the data that's, whether it comes from, whatever your data feed is, it's put out by the exchange, and, all the volume is there for everybody in the world to see. Institutional traders do their best not to signal their intentions to the market, and, as a result, pay more for a trade than intended, or sell at a lower price than they wanted. Again, these, I see these videos, people sit there and think that, the institutional traders are there trying to pick off, small retail traders. That they're not. I mean, okay, I'll take that back. Some might be, honestly. Some do. I know I did try to look for areas where there might be stops and things like that. But that's, you don't need to be an institutional trader to do that. Again, institutional traders have size that they want to trade, and, they want to do it without moving the market. They want to trade it when there's, at times when the market is most liquid, and when it's not liquid, they want to do it without moving the market. So in order to buy 5,000 mini S&Ps, if you show that in the order book, that will influence the market. I said, you put an order to buy 5,000 E-minis, and, everyone in all these little dome guys, I don't say little dome guys, but, all these scalpers will see that, and then everyone, they'll just lift all the offer. You'll see, everyone buying, 5 lots, 10 lots, or whatever, these small guys, these smaller traders, knowing, because, they see 5,000, if it's a legitimate bid, for it to get filled, oftentimes, the market will pop up on it. And again, I'll say it's knowing your market, but there's order sizes that sometimes in a market is considered big. Obviously, any market 5,000 lots is considered big, even for a very liquid market like say 10 years. Someone shows 5,000, that is big. People will see it. So again, they want to. Traders want to not show what they're going to do in the market. They want to minimize the impact of the order. The trader needs to reduce any signs of intent to the market. Now, excuse me, the institutional trader, nowadays they have a wide selection of order execution algorithms to choose from. They got VWAP, TWAP, Iceberg, Time Slicer, Ghost, percentage of volume, etc. There's you could really spend an afternoon going over many of these different execution algos. Obviously, the most common is VWAP. I don't know if I'd consider Iceberg an execution algo, but it's used by a lot of people to hide their size. Time Slicer, Ghost, percentage of volume is a common one also, where someone's got let's say buy me 5,000 mini S&Ps, be 10% of the volume, and the algo will it'll participate at the different price levels, never executing more than 10%. It's depending on the size of the order, the time of day, the order might not get finished. If say it's a smaller market and it doesn't trade enough to fill the order. If you're trading say an algo with a percentage of volume of 10%, and then you got 5,000 to buy, it'd have to trade 50,000 lots for it to fill the order. So the market could close theoretically and the order's not completed. You can go in and nowadays they have safeguards for that can speed it up or allow you to take it over and execute it. Things these are just common names. I said so many algos out there, they all got their own fancy names nowadays. Ghost is a good one. That I like. For one company's Ghost may be another different thing at another company. Ghost order would be say it's got say 10 years are offered at 12, and you got 5,000 10 years to buy. At 12, you don't want to work a bid. You just want it every time it goes offered there to buy most of the offer. So you're working a 12 bid without turning the market 12 bid. You're waiting for it to go offered, and you're just picking away at the offer in small quantities is to hide it. But that's on the execution side. When you're looking at the volume, the actual trades, it's going to show up on the volume footprint, and it's going to show up in the delta. So again, I could spend hours, at least a good afternoon, talking about these execution algos. I said there's I listed about a half a dozen here. These are the most common ones, but there's 50, at least 50, maybe more out there. Execution algorithms that are designed to preserve trading alpha. It's what's trading alpha. It's defined as return in excess of the market during the execution time frame. The goal is to minimize execution risk slippage that could negate the trading alpha generated by the trade idea. So, what you want to do, you have really, traders are measured. I'll say measured, but their alpha, their return is how they make their money. So, what you don't want to have is a case where you're losing on the trade because of sloppy execution. In simple terms, your slippage is going to kill you. And if you can, minimize that, or even get better execution to what the market was trading during that time period, then that's a great job. I cringe when I hear people talking about VWAP as like the new thing in trading. It's what people have done is they've turned VWAP into a moving average. there's a lot of limitations to VWAP, and people that are selling it as some new fancy trading indicator are really missing the entire point of what VWAP is. VWAP is a measurement of execution. It's not a moving average for the entire day. So say an order comes in to buy 5,000 mini S&Ps, and the portfolio manager is going to measure the execution against the VWAP for that time period that the order was in the market. So say it takes 5 minutes to execute the order. You're going to get your average price back on the execution for the 5,000 lots, and they'll measure the average price for the 5 minutes that it took to execute the order versus the VWAP for that 5-minute period. It's not the VWAP for the entire day, as some people would have you believe. I see these people say, oh, hey, we've gone, 1 standard deviation from VWAP, so you got to sell it, and it's going to revert back to the mean. These people don't understand what VWAP is, because, and I see it on their charts. I shake my head because, they're using it as a moving average, which is, you can't. Oh, I mean, you can, but using it for trading as a moving average, I think is poor, in the sense that over the course of the day, VWAP is going to get flat, and if you're going to have movements in the afternoon, it's too late. VWAP's already taken in all the morning session. Majority of the volume is going to be done around the cash open, in the S&Ps. If you're trading VWAP and you got it going back all the way to the evening session reopen, then you're really screwed. It's not going to move very much if there's a big move in the afternoon. And, if you're selling it when it goes 1 standard deviation above it, thinking it's going to revert back and the market's just going to take off and go higher, it's going to go 2 standard deviations, 3 standard deviations against you. So that's not the intention of VWAP. The VWAP is a measurement for execution. So, as the day goes on, VWAP is going to get flatter in general. It's volume weighted average price. And if you're having, by 1 o'clock, you already got, 85% of the volume traded for the day that's already being calculated into the VWAP, then, it's not going to move very much. I mean, it'll move, but, not a whole heck of a lot. Said, VWAP is used by institutional traders as a measurement of execution. That's how, the portfolio manager will say to a broker, you suck, you butchered my order because, you traded it, you're buying it and you bought it, half a point above VWAP. You're a lousy broker, and then you'll be in the, then that broker will be in the box, the penalty box, and not getting any orders for a while until his new broker gets, screws it up. No one got rich beating VWAP, except maybe the broker. I mean, that's why all these banks are spending tons and tons of money so they can beat VWAP, and get the execution alpha. So, because like I said, you don't want your trading alpha being, reduced because of your execution alpha. So, okay, remember, just go back to the basics. Every buyer, there's a seller. So, what is important to know is who is being aggressive, buyers or sellers. Aggressive behavior shows up in the delta. Again, what is this? This is an E-mini 10 range chart. And, you can see it's just sort of, humming along, minus 300, positive 500, positive 1500, 78, wham, minus 2400, minus 3000. You're seeing in these two bars the aggressive selling really take over. I mean, this one's kind of, say kind of aggressive. It's strong. 1500, 1556 is a strong number. But what you're seeing here is, just sort of, this market sort of humming along, facilitating trade, and then you see this big sellers come in. This is the Delta Scalper signal right here. It's got the little down arrow, and it's got the it draws out a zone. This is fuchsia color if it's a sell, and if it's blue underneath, it would be a buy. You'll see buys later. So Delta Scalper draws out a zone 5 bars from the initial bar columns from the initial bar where the signal is generated. So it'll draw it out. So this is 1 column, 2, 3. So it'll cover five bars. I mean, you could adjust that, say you don't want it, say you just want it on the 1 bar. That's fine. You can adjust that as well. You can adjust the colors, adjust what symbol you want. I like the arrow for the Delta Scalper. Now, the reason the zone is drawn out to see how the market reverts afterwards. So, reversion identifies if the impact of the initial jump in Delta was temporary or permanent. So if price reverts all the way back to the price at the start of the bar where the signal appeared, then the impact was likely, then the market, I changed that, then the market was likely impacted by the large trade. Either the order cannot easily be absorbed by the market supply or demand, or the execution algo was trading too aggressively, pushing price away at the time. I'll give you a few examples. So, okay, here's a sell signal, and market started to move away. It reverted back here, then before it started coming off. Here's a buy. Okay, it started popping up. Sort of, you can see, this is the order. Probably working its way through the market. Started coming off, came back down to this level, and then took off again. Again, this is a E-mini, this is a 5-range chart. The Delta Scalper is kicking in right here. Comes off, sort of trades back up there, starts to come up again. You get another signal, it's just sort of hanging around before it finally sells off. So, it's sort of, you see the initial push here, maybe another push here, it could, it doesn't necessarily have to be one order, one trader. The market's full of many different traders, doing their own thing. Nobody's, there's no conspiracy. Traders are doing what they think they need to do. So, people are, someone came up here thinking, hey, it's a good sell. Right? Then, they're still hanging around these prices, more people come in, hey, yeah, this is a good sell. I want to get short as well. And then you see it just sort of falling over there. I find these reversions oftentimes can offer a low risk entry because what you're seeing is, short-term demand for liquidity to get a big order filled is what's pushing the price a bit. So the push is picked up by other participants, and oftentimes they join in causing the move to start. Now, just go back again. So you get the little sell-off here. You get a little, further selling. Okay, it sort of stops. Comes back in. Then it kicks off again. It doesn't. There's all sorts of different reasons for why it can be reverting back. It could be, the initial order got filled. Okay, or the order could be chopped up in different pieces, and okay, this is the first tranche, this is the second tranche, or this is the third tranche. I mean, these orders, I don't know. I could spend all day talking about different types of order algos, but what they'll do is they'll take an order, they'll chop it up, and they'll start executing different pieces of it. The tranche is a word, say it's 5,000, it'll do the first tranche of 1,000, the second tranche of another 1,000, third tranche of another 1,000, fourth tranche of, another 1,000. I said, that's from my experience at JP Morgan. Someone from Credit Suisse could have a totally different view of it. But I do like when it sort of holds back at these levels. When it holds back to the initial bar. Sometimes it may, go back through it by a tick or two, and that's fine. I can accept it. The market's going to do what it's going to do. I'm not using this as as a dead stop level that if it hits this level, it gets through it by a tick. The world's coming to an end, and I have to get out of the position. No. Now again, that said, I don't like reversions that go past the zone though. And a good execution algo will not push the price too much while filling the order. Sometimes, though, it can't be avoided. These are two separate things. They're not linked. So, again, I said I don't like reversions that go past the zone. I can accept it when it goes through the zone by, a few ticks, and depending on the bar type. So, like, this is a red candle, right? So it's going down, 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 but it's given, there was some buying earlier in the bar that sort of just dried up, but the bar turned down, right? Because you see it's got a positive delta, 27900. But earlier in the bar, there was some very aggressive buying going on, 6,000 here, 6,000, 3,000. And it just stopped for whatever reason. Maybe, the order got filled, or, the wave of buying that it was doing was executing, stopped, or, maybe someone was trading it manually and said, okay, I'll give it a chance to breathe. And it came off and came down by, 2 ticks to a new low. And then, but you still see in here, the next bar still got a strong positive delta of 2,000. And the market just, started ticking back up again and then just went higher. So, I said, sometimes you got to take these things into context as well. That's why I like the order flow chart, trading it with an order flow chart. Even though the software does run on a bar chart, I think with an order flow chart, you get, you could really appreciate what you're looking at much better. And understand what's going on. With an order flow chart, you'll understand what's happening in the market much better than a normal bar chart. So then again, I said even if you breach it by a tick or two, again, it's not the end of the world. You got to take into account what's happening in the market. So remember, price moves. The reason price moves is because it takes aggressive buyers, a seller, to clear out the bids or offers and move the market to the next price level. When there are strong aggressive buyers and sellers in the market, there's often a big order or orders in the market at that time. People, there's a big order, it needs to get filled. You got to be aggressive. There's no two ways about it. You can sit there and try and work a bid, but if the market's not coming to you, you got to get it done. You got to start buying the offer. You got 5,000 minis. You sit on the bid for 5,000. Iceberg 50, showing 50 at a time. But if there's not much trading going on, people aren't so unless someone's got 5,000 to sell to you, at some point you're going to have to get aggressive, because what you don't want to happen is you don't want the market to start ticking higher and you're not participating. That's the worst thing that can happen for a trader, is the market start to move away and he's not participating, and ultimately his average price will be bad. You got to participate at the price levels, and that's what these execution algos can do. I mean, now there's they have these algos, they've gotten much more better, where it'll sit on a bid. It knows you got 5,000 to buy. It'll work bids, and if nothing's happening, it'll start lifting the offer. Or if the offers start trading, it'll start lifting the offer as well. There's, again, you can spend all day talking about the different execution algos, but I won't get into that. So as I said before, the reason doesn't matter to you, the trader, why the market's moving, because you never know the information a real money trader has, or why hedge fund is liquidating the position now or getting into a position. What you need to do is recognize when it's happening, and that's what the Delta Scalper does. It shows you on your screen when these levels occur. The Delta Scalper allows you to see the positive or negative expansion between buyers and sellers, so that you can make predictable and exploitable positions in the market. What you want to do is, you want to find, people, you always talk about, oh, you got to have an edge. I don't necessarily say you have to have an edge. The way I look at it is you have to have a way to exploit what's happening in the market. Take advantage of it. The last thing you want to do, I can't stress this enough. I mean, even, there's so many participants in the market, right? And big participants are the ones that move the market. Now, what do you want to do? Do you want to fight against them? Try and fade them all the time? No, you're going to get crushed. You're going to get killed. You're going to go broke. You're not say go broke, but your account's going to go down pretty quick, and you're probably going to stop trading, and you're going to say, oh, everyone's against me. What you want to be doing is, you want to be participating in the direction that the big traders are going. I mean, I don't know how else to say that, but if I don't want to call it smart money, but if the big money is, it's the big money that's going to be moving the market, and what you want to do is you want to position yourself in the same direction. That's why you see all these dome traders, when they see a big bid come in, they immediately lift the offer because they know that this big bid is going to come in. It will often, act as support to the market, and if it starts to raise, if that bidder starts to raise their price, the price is going to go higher. That's why they're jumping in front of it. That's more of on a micro level. Volume footprint, I think, gives you not a macro view, but a slightly larger view, slightly larger view. So, again, here's another example. This is in the bonds, right? You got the delta scalper kicking off. As you're going up, you just sort of see the deltas, getting a bit average, and then, the strong sellers take over. The aggressive sellers, 364, 344, as the market sells off by, what is that, 9 ticks. Okay, one of the main reasons so many traders lose money or fail at trading is because they come in with the market come in to the market thinking all they have to do is buy low, sell high. Well, that may sound a little logical and prudent. It's probably one of the main reasons traders blow out, because they simply don't know where the low is to buy or where the high is to sell. How many times have you bought only to have the market keep dropping as soon as you bought, or sold thinking this is the high and the market's going to, market just keeps going higher against you? Not even, take out trying to pick the high or the low. How often have you bought and immediately after you bought, the market sells off, and you just basically left, I'll say left holding the bag, but you're just immediately seconds after you get into position, it's against you, and it's against you the whole time, and you got to take the loss. So it's easy to look at a bar chart after the fact and say, oh yeah, I would have bought here, sold here, I bought low, sell high. Yeah, that's what you want to do, but oftentimes people don't know where buying a low price is to buy, where to buy at a low price, and conversely where to sell at a high price to buy lower. What they should be doing when they come into the market is, instead of thinking buy low, sell high, yeah, that's your goal, I guess, in a way. But what you should be doing is you should be buying when the market is showing strength and sell when the market is showing weakness. Successful traders buy high and sell higher. They sell low and buy lower. And, if the market's showing strength and it's going high, going up, they know that they could buy here and sell at a higher price. Or if the market is showing weakness, they'll sell now, even if the price is low, and just buy it back lower. So, I hate to say, think like a mercenary. You want to fight on the side that's winning. You don't want to waste your time trying to fight a losing battle, trying to pick highs and lows, trying to gain glory. No one's going to pat you on the back saying, oh, you picked the high, that's a great job. No one cares. No one cares about that. You don't get an award for buying the low of the day, or you get an award for selling at the high of the day. You get rewarded for making money, period. Your first priority as a trader is to stay alive and earn a living, and you do that by being on the winning side, whether be in a battle or in the markets. If neither side is winning, that's the beauty of Delta Scalper. You don't need to fight or trade at all. You just sit on the side until someone comes in and beats the other side up. The Delta Scalper isn't kicking off signals left and right all day long. Honestly, I had a guy, he bought it, I don't know, and I tried it for a day and it didn't work. Well, he didn't really get into it on what he was doing and what he was looking. I emailed him back, and he's just one of these guys, I think, just wants to go out and buy every single indicator, and thinks he's going to turn the market into his personal cash machine. And I tried it on 6 markets, I tried it in simulator, and I lost money. Okay, well, you tried it for one day. I don't even know what time frame you're looking at. Nothing. It just kills me. Because unfortunately, I've met since I've been created orderflows.com. Yeah, I've had the pleasure of meeting, people that really want to learn how to trade, and people that know how to trade, and it's you see all sorts of I'll say characters, but you see all sorts of people come up, and like this guy that bought it, then immediately asked for a refund, which I gave him. Because it's not something that so I'm not here to try and take everybody's money. I put this stuff out there for people to learn and digest. And maybe sometimes people come to me with ideas as well, and it's an exchange of ideas. That's how traders grow. You don't grow by sitting in a room by yourself and running sims all day long. I mean, there are idiot savants that probably do that. We're not Rain Man or anything like that. We're normal people. And good traders have interaction with other people. It's exchanges of ideas that will help you grow. But the beauty of Delta Scalper is, I said, it keeps you out of, if the market is just, if no one side is showing strength or weakness, it keeps you out. Again, it's going back, it's if if a person isn't going to take the time to learn something, to learn the markets, learn how to trade, no matter what, you could have the greatest indicator in the world, it's not going to help you. Just because you go out and buy a Ferrari doesn't make you a race car driver. It doesn't make you a good driver because you own a Ferrari. A lot of guys buy Ferraris are crappy drivers. They just get it for whatever reason. And it's the same thing with trading. People think, hey, I buy this system for $10,000, $5,000. It's going to make me a good trader. It's not. I mean, a person has to have the ability to want to learn how to trade. If they're new, or even successful traders, are open to it. For example, great basketball players have become good basketball players become great basketball players with the right coaching. You could have the right the foundation down, but without someone out there to tell you sort of help you push you along, you're not going to become, I'll say great, but good at it. I mean, you could all you see all of these these high school prospects that are good, and very few go on to the NBA. Not everyone's going to go on to the NBA, but the ones that develop in college, and very, very few that make, how many successful basketball players have made the jump from high school to the pros, outside of LeBron James or Kobe Bryant, that you can remember. They may last a year or two, but, Kobe Bryant became great. He was a good basketball player, but he became great with, Phil Jackson. People will argue that, saying, well, he was, greatness was coming to him. LeBron James was good, by himself. I mean, anybody that could take Cleveland to the finals, that says a lot. But he became great, I think, with when Pat Riley got involved, and to a lesser extent, I think Coach K from Duke. He was the national team coach, and he coached LeBron in the Olympic team. So for all those years, it wasn't like daily coaching, but it was coaching. So it's Delta Scalper's a tool, right? It's not the end all golden holy grail for trading. So if you come in thinking that's what it is, just turn off the video now. Don't waste your time. It's here to help you understand the market a bit more. Yes, you can use it as a pure indicator if you want, but I'm telling you right now, it's a very good tool. It makes me a lot of money. Makes people I know a lot of money as well. And but it's a tool, just like anything else. If you think you're gonna just all of a sudden take every single signal, and not understand, stop placements or anything like that, you're doomed to fail. Whether, I said again, it's just like having a fancy car. What good is it if you don't know how to drive it properly? So, okay, again, let's look at some more charts here. So this is a E-mini 10 range. And again, we came down into the low. You're seeing some selling coming down into the low, which you're supposed to see, right? You're coming into the low with negative deltas. That's what you expect to see coming into the lows. you hit this low here, you got a delta scalper signal kicking off. And, it's got a positive delta, and, you got a divergence, it's an order flows divergence where you got a new low and, a positive delta in an up candle. That's an order flows divergence, but what's important also is getting the delta scalper kicking off as well. So you're seeing a shift, right? The market has gone from a supply-driven market to a demand-driven market. You're seeing the shift happen here. That's what delta scalpers is picking up on. I talk about the order algos, execution algos a lot earlier, but really also what it's telling you sometimes is you're seeing a shift in the market psychology from, especially when you're at highs or lows, you're seeing a shift in supply and demand. As I said earlier, that's what it helps you pick up. And especially as the market's going down, it's supply driven. As it's going up, it's demand driven. So order flows delta scalper shows you clearly at what price level were high probable highs and lows. Also, swing highs and lows may be occurring based on order flow. Now, let me stress at this point, order flows delta scalper won't pick every single high and low. That's not what it's designed to do. It's not designed to pick highs and lows. It's designed, what it's doing, what it's looking for are areas where buyers are overwhelming sellers or sellers are overwhelming the buyers. Those are areas where you can make profits. It's those areas, where the one side is overwhelming the other, that oftentimes that's where the shift in supply and demand is occurring. Okay, so let's just jump into a bunch of charts here. I have these labeled, some are sequential, 1, 2, 3s. So we'll see. So this is a bond. So bonds had been going up. This is a recent chart. It's April 7. Bonds have been going up this morning. You make new highs. Again, this is a high. This green line is a high. And, right up here at the high, you're getting a signal, delta scalper kicking in. So, again, this case, it was a demand-driven market. And you're getting a sign up here that, hey, this could be the high. You could be seeing sellers coming in finally to take control of the market. It didn't kick off here where you had the negative delta. It didn't kick off here. You don't think just because you got negative delta, it's kicking it off. There's more to it. I'm not giving out the entire key to the kingdom, but at the same time, I'm trying to explain everything to you so you can understand. Because if I tell everybody the calculation that goes into it, I hate to say it's a black box, but there is proprietary information in it. So if I give everyone the calculation that goes into it, some guy will go out and say, oh, this is the E-mini delta trader and sell it for $5,000 to people or something like that. That's not the point in, why, that's one of the reasons why I don't want to, give everyone the exact calculation. But, what it's doing is it's taking delta readings, over what's happening over this move. And it's picking these areas where where it looks like it sees a shift in, what was supply into, or sorry, what was demand into the supply-driven market. So, it's taking into account, what's happening earlier, the move earlier, the delta, for some of these previous bars. So what happens in the next, this is that, the high here at 167 even. Okay, so, got the delta scalper kick in, and, okay, boom, the next two bars, it goes lower. It reverts back to this high level, and then, on the order flows trader, you're getting a ratio here, and you're getting a buying imbalance right on the high, which, these two by itself this is an order flows sign, to get short. And the fact that it reverted back to this mean, is telling me that, there's strong sellers up here. And earlier you saw it happening, when we first hit this high, that, the delta scalper kicked in, that, that the sellers were appearing to taking control of the market, and, they sort of ran through their order, but then, it sort of came back, people started to try to push it back up. But then again, at this level now, what you're seeing here is this is an order flow reading, the market came off. So this is the next chart. Okay, so this is the next sequence of charts I want to show you. This is bond. Again, it's a 4 range. This is April 4th. And, what time? It's around lunchtime. We're coming down, trading back and forth a little bit. Then, here it's kicking off a delta scalper signal, a short signal. You're seeing, it's reading, the deltas that's happening before and, doing its calculation to sort of, it's telling you that, hey, it looks like, the market is changing, or not say changing in this case, it's telling you that sellers are taking control. It didn't kick off here. Just, it's not just because you have a big negative delta of 525, because otherwise it would have kicked off here, minus 429. So, don't think just because, it's a big delta, it's giving off the signal. It reads in, it reads in the previous bars, things like that. And, and so, what happens? We start drifting lower. So again, you're getting short somewhere, 164.30. In the next 2 bars, you see the selling. Yeah, it's a little bit, I'll say a little bit weak initially, but you see the deltas, sort of contract a little bit. So it's not necessarily the strongest move. It did revert back, which is giving you a chance to get in again. So initially, when I see it, delta gets small like this, it's telling me the order, the order that's being executed is being run through. So, I'm not surprised to see the pullback here. So, there's probably an order, the order to sell is being executed, boom, boom, boom here. Then it just sort of runs through its course, and then, the market just sort of reverts back up to this level. But by this time, people are saying, people say, well, it's a double top or something, it's a tick off. But then, now you're starting to see some things in the order flow, it's a single print here, a ratio, and the market starts to come off. Now it comes off to this area down here where you got another delta scalper signal kicking off. You got an order flows thing there, but I'll pull up, what you're seeing here. So now, you saw the move, on the previous bar, down from, what was that? 165 even down to, a half a point, 164.16 before it starts kicking in here at 164.20. And, you're seeing, this is where we are. You're seeing, the delta scalper kick in. You got, a ratio here that you like on the order flows trader. And the market just, it goes right back up to these levels. That's it's half a point, half a full point. I'll say you don't get the whole thing, but say you got 10 ticks out of it, but you get another 10 ticks on the way back up at least. So that's, these are some nice signals that it's kicking off. Okay, what is this? This is a bond, just a quick one again, a bond chart. And, you got a ratio here that you like. You got the single print, you got the delta scalper kicking in. And, so you're getting, this is why I like to see it on the order flows chart as opposed to just the bar chart. I'll show you some bar charts later, but, when I see it on an order flows chart, to me that's, and I see confirmation, in the order flow when the delta scalper is kicking off, that's what makes it more powerful rather than just looking at a normal bar chart. So you're getting short, you get short somewhere 166.07, you get down to, 01, 00. It's a nice move. Okay, here's a E-mini chart. This is a 5 range. Again, this is April 7th, so it's pretty recent. And, you come down into this low, and it kicks off of a buy, right down here. It didn't kick off a buy here or, a buy here. It's not just because you got a positive delta, after some numbers. Again, it takes in, there's things it takes into account other than just the single delta that appears here. And, the market, it goes up a little bit, comes back down, sort of reverts back into this 28 level. And then, what happens in the next, over the next couple bars, and it starts to shoot up. You're seeing the positive deltas as the move goes higher. You get up, from, 28 was this was 28 level where the signal kicked off. Then again, here, if you don't know where to get out on a trade, that's where again, I can't talk about it enough. Order flows can help you trade. The volume footprint chart can help you determine when to be getting out of a position. In this case, you've got, you got a delta scalper kicking off, but you also have a stack selling imbalance. You got a ratio in here, and you got a ratio after it. I love getting the stacked imbalances with ratios after it. And so even if you didn't have the delta scalper telling you here that it's changed, get out, the order flow is telling you to get out. And then the market sold right back down, even took out the lows. So you're getting 2 to 3 points up there, you're getting another 2 to 3 points on the way down again. Okay, so I showed you a lot of winning trades, but there are times that the trades are just losers. That you get stopped out. You have to use stops in the market. Here's sort of trying to saying hey, things are changing here. It looks like we're going to start going higher. You see things really pick up. Here you got a very strong positive deltas. It's like all signal, all signs go. You're off the low with positive delta. You got a divergence. It's building up. You're seeing some strong aggressive buying coming in here in the form, in the form of positive delta. But what happens? It just sort of runs through it. Maybe there's a big order. Whatever. It could be a basket order. Against cash, and maybe the people were hedging or something. You don't know. You don't know. You don't know what, or the other, or what an order is being executed in the market by another broker, by a bank. You don't know the reason why it's being executed. But what you want to know is that it's being executed. That's the important part. So maybe the order ran through. This is quite a bit. The volume is 65,000 in this bar. So it's probably a good 30,000 lots there that were bought. And, the order ran through its course, and, then the market just fell off. It just fell right through. This is why I talk about once it gets on the other side of, of the zone, I don't like it. Usually my stop is somewhere, it's not right below it by a tick. Something, if it's clearly through it, by a point, okay. I'll take my licks, take my loss, and move on with life. Not every trade is going to be a winner. So again, failed signal followed by a winning signal. Here it's telling you to get short. Okay, didn't work out. Buying came back in this next bar, went a little bit higher. Then you get another signal here. It's right around that same area. So maybe there's an order, an order being executed. Some strong selling. It stopped for whatever reason. Maybe the first tranche got done. Now you're seeing the second tranche come in. And, or someone could be executing and say, okay, I'll let the market breathe for a bit. Say someone's got some selling to do. Maybe someone's executing it manually. You don't know. And said, okay, yeah, I sold, I sold a couple thousand. Now let it sit for a while. And they see the market comes back up. Okay, hey, it's starting to come back down now. I better get involved again and sell some more. And, and it comes right back. So you take a small loss here, but then you get it back in the next trade. So the next charts I'll show you is, different types of charts you can run it on. So this is a uni-wrinkle chart. So it doesn't have to be an order flow. For me personally, I think the order flows charts it works great on. This is a uni-wrinkle chart again. Like I said, it's kicking off a buy here, sell here, buy here. It said, by definition, is a delta scalper. Initially, I wanted something more of a short term. Not necessarily a long term to be holding it for such a long term. Honestly, I didn't bother really looking at these charts until someone pointed them out to me that it actually works pretty darn good on other types of charts. It's in case someone says, "Oh, you're just cherry picking this day." Yeah, I did. I just happened. I just pulled up my charts for the last week, and this is on what day was this? This was on the 12th. In the last 2 weeks, I picked up my charts, and so yeah, I'll say, hey, there's a great example. I might as well put it in there. But I'll show you, over the course of, this is the rest of the week. So this is the 11th, 12th, 13th, 14th, 15th. Okay, so this is the 11th. That's this chart right here. That's this day. So how did it look on the 12th? Okay, so you got a sell here. Sell didn't work out. The sell here worked out. A nice buy here. The sell stopped you out. The sell stopped you out. This buy. These sells kind of went sideways. I don't know if you still would have held it in here to get stopped out. So the next day you got a sell. It went down. A buy. It did go up initially. Sort of came back on in the zone. Maybe could have stopped you out. I don't know. Depends if you didn't get out already. Towards the close, I don't think you'd taken that signal. On the 14th, what do you got? You got a sell here, a buy here, a sell here, a buy here, a buy here. Then on the 15th, what do you got? You got a buy here, a sell here. that's the end of the week. So, everyone says, oh, you're cherry picking the trades. Am I, I'm trying to show you good examples. I showed you some bad examples, but, this is one day out of this whole week here. I could have showed you this day. I could have showed you this day. I could have showed you this day. This was the beginning of the week. I showed you that day. What is this? This is an E-mini 5-minute chart. What day is this? This is the 11th. What day was this? This was the 12th. Okay, so this is a Uni-Renko chart on the 12th. This is a minute chart, 5-minute chart on the 11th. So the day before, it's giving you a buy here, a buy here, a buy here, a buy here. This one eventually came off and sold off. Again, you gotta have targets. You gotta have stops in. I mean, don't think that, oh, hey, it's giving you a buy here. I'm going to hold it all the way, till the end. No, you gotta have stops in. Okay, so for, what's the next chart? Okay, that's more of a 5-minute weekly chart. Again, for everyone to say, oh, you're just cherry picking this. Yeah, I did cherry pick it. I picked one day and I'm showing you. So, let's go back. I don't know what day this is. This is, so this is the 11th. This is this chart here is right here. The 12th, you got to buy here, sell here, sell here. 13, you got to sell here, stop you out, buy, didn't work out. This sell, nope, this sell did. This buy stopped you out, this sell worked out, this one kind of worked out, but it's a little close to the close here. This sell worked out, this buy went into the close. So there'll be days when the results are mediocre. Like this day, it just, it didn't really work out. This one worked out. This one worked out. This one, not really. This one, yeah, kind of did, but then turned around, stopped you out. Then there's going to be days where it works very well. Okay, this one, stopped you out. This one, maybe stopped you out if you held it. Maybe it didn't. Here it's giving you a sell. Here's a nice buy. Here's a beautiful sell. Here's a nice buy. You have to have stops. There's no way around it. You have to have stops in the market. You want to limit your risk. Every trader should use stops in the market. So, let's talk about some of the settings real quick. Negative delta strength and positive delta strength measure the power of the aggressive buyers and sellers. It's set to 1. If you really want to go very strong, you can set it to 2. Look back bars, just sort of, go back, how many bars it's using for its calculations. Signal box height and, width are these, how many ticks you want it to be and how many bars across. It's 2 and 5. Signal mark displacement is how close you want the arrow to the box. You can change the colors. You can change, here the colors. I have a fuchsia and royal blue. I have a triangle, and I set the width to 5, so it's a little bit easier to see. If you have it set to small, then it's hard to see sometimes. So questions I get often is, what's the best type of chart to run Delta Scalper on? Obviously, for me, order flows trader chart is number 1. Range-based charts is fine. Renko charts are fine. Time-based charts are fine. It can be used with how you're trading. At the end of the day, it comes down to your own trading style and your appetite for risk. It depends on what type of trader you are. What sort of chart you look at. Honestly, if I don't look at it much beyond 5 minutes. Honest, for me, I haven't really looked at it on 15-minute charts or above. So it's called the Delta Scalper. Because it should be short-term positions. Again, I'm not looking for you to hold it. You're buying it at 9 o'clock, holding it until 3 o'clock. It was designed for trading crude actually, but it works great on other charts. That leads into the next question I get: what's the best market to run the scalper on? I run it on E-minis, bonds, 10s, 5s, crude, WUNs, Euro stocks, and Nikkei. Again, it'll run on pretty much any futures market that has decent intraday volume, which is most contracts, even grains, right? Even metals. But for me, I tend to stick to the most liquid markets in my trading. Okay, so it runs on NinjaTrader. And again, it was designed to run any type of chart. Order flows, volume, footprint chart. It could run on bar charts, run on Renko charts, candlestick charts, range bars, any type of charts. And again, pretty much any time frame. the charts I showed you are on NinjaTrader 7. We have a version ready, I believe, for NinjaTrader 8, and NinjaTrader 8 is still in beta. I don't necessarily recommend trading real money on a software that's still in beta. Yes, that's the only way you'll find out problems is to actually use it. But for me, trading my own money, I'd rather wait till NinjaTrader 8 comes out of beta. The upgrade, say you're using NinjaTrader 7 for Delta Scalper, the upgrade to NT8 will be free. Just tell me that you need it. The software is machine specific, which means you have to tell me your machine ID. You can only run it on one PC. If you need another license, we do offer additional license at reduced prices. So if you change PCs, for example, you get a new trading PC, just let us know and we'll change the license over to your new PC. It's not going to cost you anything. Okay, so, excuse me. At the beginning, I promised you some special offers. So, originally I was only offering Delta Scalper to my existing Order Flows Trader software users. But for a short time, I've decided to open up to anyone interested in the software, partly because a few of my users have shown it to friends and they've wanted it as well. And I can say no, but at the same time, these people, they write me their life story, and it's yeah, I want to help them also. I'm there to help people. I'm not here to sell my stuff for thousands of dollars and then that's the end of it and you never hear from me again. So, right now you get Delta Scalper for $250. It's not a lot of money. It's, I said, I'm sure, if I put up all my equations for it online, someone would probably come and do it and repackage it and call it the Delta Super Duper Trader and, sell it for $5,000 or something like that and run it in a trading room and say, join the trading room for $400 a month or something like that. That's not what it's like. But anyway, price will be going up soon, and once I hit 50 copies, I'll probably just be closing it down and not offering it anymore. I said, I don't do this as my main source of income. I do this to help other traders that want to learn how to trade. So, you could visit orderflows.com, www.orderflows.com, or I created a special little site for deltascalper.com as well. Now, as a special offer, if you don't have the Order Flows Trader software package that you saw, the footprint charts, I will put together a special package, which includes the Order Flows Trader software, the Delta Scalper, and a few other things. I got a 15-hour trading course. I'll give you a special price on it. Usually, if you buy all these things separately, I'll say all these things, there's only a few things that I have. But if you buy each thing separately, it'll cost you, $1,500. But, you just email me, tell me, hey, I want your special offer on your everything, your Order Flows Trader, your education, your Delta Scalper. And I'm here to, I'm here to help you guys, become better traders, not necessarily to, squeeze money out of you. I like to have relationships with my traders, and, spend time with them and, and understand, what their needs are in the market and help them become a better trader. So, just email me, mike@orderflows.com, or visit www.orderflows.com or www.deltascalper.com. So, thanks for watching this video. And, it went, about an hour and a half long. And, again, any questions, you could contact me through my website or via email. And, I'll do my best to reply in a timely fashion. It's basically me and my programmer. And, sometimes I get a lot of emails that, may take me a day or two to get back to you. But, I do my best to get back to everyone. And if I don't, just sort of send a follow-up, say, hey, man, here's my question again. And, I'll do my best to get back to you. Anyway, thanks for watching this, and I hope to hear from you. Goodbye.